Good day, everyone. I'm Chan. I started sustainable investing sometime around 2012 and 2013. Since then, ESG type investment has grown quite a lot as it becomes more and more popular among retail investors. And ESG investment fund is gradually becoming a big business for fund managers. I have learned along the way that the best practice in investment quite often runs counter to our intuitive desires to be rewarded by engaging in sustainable behavior. So let me explain why. We always make decisions by weighing the risk of the decisions that we are making and comparing it against the potential rewards. Therefore, we take more risk if the potential rewards continue to grow, but we take less risk if the potential rewards continue to decline. After all, why take more risk if we are expecting to get diminishing returns, as it is against our self-interest? Moving on to ESG investment, inherently, the perception is that ESG type investments are safer, hence less risky. Since businesses work actively to minimize negative externalities or consequences onto society, irrespective of the subjectivity of these negative externalities. Therefore, ESG type investments should have lower expected returns because these businesses are seen as less risky. In fact, over the period of 2004 to 2018, there is evidence presented by Cicerati et al., which shows that companies with higher ESG scores show lower average return. For non-ESG or lower-rated ESG companies, these businesses are seen as more risky. Thus, any investors who sees a risky business would only invest in this business provided that the expected returns is higher, not lower, to compensate for more risk being taken by the investor. Therefore, it is not factually accurate to say that high ESG scoring companies have higher returns because the risk involved is actually lower. You can only command higher returns provided that the risk is higher, not lower. Moving on beyond risk and return of ESG businesses into ESG funds. Any investment fund, even ESG type investment fund, has a list of companies that the fund has invested in. A higher rated ESG investment fund has smaller list of portfolio companies, as those that don't make the cut are screened out by the fund. What this means is that ESG fund is carrying more risk, or in other words, having more cluster risk, since it has concentrated exposure to smaller set of companies, or in other words, the bets are less spread out. An ESG fund is therefore taking more risk, with lower expected returns and real returns, which runs counter to the principles of making good decisions, especially investment decisions. In fact, Barbell et al. Find that venture capital funds with both societal and financial goals earn 4.7% lower returns than traditional funds. ESG funds also require more active ongoing management to ensure that their portfolio companies continuously adhere to ESG standards. Such actively managed funds increase the fund management fees by 2 to 4 folds compared to conventional non-ESG funds. Therefore, for investors, including retail investors like me, to put money into ESG funds instead of non-ESG allocations, there are 3 key takeaways. Firstly, investing in ESG funds means taking on more risk. Secondly, we are to expect lower returns, not higher returns after taking more risk. And thirdly, we will be paying more for the fund management fees as well to enforce ESG adherence. The outlook from International Monetary Fund is forecasting that the global inflation will continue to outpace global growth by 1 to 3 percentage points into 2023 and 2024. With this outlook in mind, we have to ask ourselves this tough question. Will we be all right as we run the real risk of having our wealth disappearing right in front of our eyes should we put all our money into ESG investments? Would we want our pension funds to invest in ESG funds? What will happen to our retirement account if all our pension funds are in ESG funds? That's it for today. If you like this video, please click like and subscribe to my channel. Thank you.